Welcome to the Financial Thought Exchange podcast from the CFA Institute Research Foundation. This is where you get wiser by sitting in on the conversations with the leading thinkers in finance. I'm your host, Lotta Moberg, and this is the first of a series of videos on alternative credit. We're launching this to highlight and share the content of our latest piece, An Introduction to Alternative Credit, which is a collaborative project between the Research Foundation and the CFA Society of New York. And Alfonso Ricciardelli helped us put all of this together, and he also wrote the introduction to this piece. So thank you very much, and welcome, Alfonso.
Thank you, Laura. It's a pleasure to be here.
And we're really happy to have you here. So excited for this piece and excited for everybody who gets to read it as it comes out in just a couple of weeks, but probably it's come out by the time that we launched this video. As an introduction, Alfonso is the co-founder of Noosk. This is a platform that allows users to share knowledge-based content. And Alfonso himself has about a decade of experience in the financial sector, both on the buy and the sell side, as well as in the public sector, where he's been working a lot with EU policymaking as well. So to kick this off, Alfonso, this piece is about alternative credit. So for those not quite as deeply in the know as you are, how would you define it? What is actually the space that we're talking about, alternative credit?
Yeah. So first of all, hi everyone, and again, thanks, Lana, for having me. Alternative credit is really a type of fixed income allocation which has a different risk return profiles compared to what is known as traditional fixed income, which is usually publicly traded bonds. It's a heterogeneous asset class which includes different types of lending, such as trade finance or infrastructure credit. But broadly speaking, there's three common features. The first one is that private credit transactions have a bespoke nature, so they're different from one another. The smaller market size, it's another of the key features compared to the traditional fixed income investment pool, mostly due to stricter allocation rules. And there's also lower liquidity, of course, which is typically associated with higher yields.
Excellent. So far, if we think about there are different strategies, obviously there's so many different ones. As we cover in this piece, which areas of alternative credit would you say have attracted most capital so far?
Yeah, so some strategies are more niche. Sometimes it's just because they're newer. Think about venture debt, right, which is really very, very new. But others, they're more established and have a larger investor base, sometimes because they're relatively more liquid or have existed for a longer amount of time. So if it's hard to sort of make it into a ranking, but at the end of the day, it usually depends on several factors: liquidity and how established is the strategy. For the numbers, think of real estate debt and think about infrastructure debt as being usually more strategies that have historically attracted larger investment bases. But it's hard to think about it as a common space altogether, because these investment strategies are very different. The thing that sort of makes them that puts them together is the fact that they're alternative to traditional fixed income allocations.
Most people will probably think about maybe somebody has at some point approached them, if they're not invested already, in, say, a credit fund, right? And I think that's what you mean when we talk about venture debt. That's like what often you lend to a startup or the like. But as I understand, the space goes beyond what as a personal, like a credit investor, you can be an LP in a fund. It's also like bank lending, like special kinds of bank lending and the like. Maybe we'll shine some color on that.
It usually goes beyond traditional bank lending. So it's everything that goes beyond traditional bank lending. Historically, one of the breaking points in this strategy has been the global financial crisis, because it has opened up by restricting the type of lending that banks could do. it has actually opened up the sector to funds. And so I think that's how the alternative credit sort of field developed and grew 13-fold actually since 2006. But typically it's non-traditional bank lending, especially in the Western world, like in the US or in Europe.
So that's interesting. So
Just
there was this moment in time, financial crisis. This is the global financial crisis, 2007, 2009, where a lot of this took off. So the space existed prior to that, I assume. And then with this event, like it grew. So what actually happened? Maybe you can dig it a little bit more into that.
Yeah, it's simply that post global financial crisis, governments decided to regulate bank lending, and so they made it stricter. And so a lot of banks in a lot of banks were also a little bit sort of burned, because of the crisis, because of what happened in the especially in the real estate market, with the mortgage-backed securities and all the synthetic products that were built out of that. And because of that, banks kind of stopped or greatly reduced this form of lending. And so funds came in, and because of that, this space basically exploded. And so while growth started before the financial crisis, it accelerated during the financial crisis, and now the space is 13 times larger than in 2006, which, it's a
So
big
you think
number.
of when you think about financial regulations, right? You think about the government's coming and hampering any kind of credit provision in this context. But here you're saying the regulations fell on the bigger institutions and therefore the smaller stepped in.
Yeah, and some banks really became overly careful and just simply stopped doing those forms of transactions because the when the government stepped in and after the crisis, the sort of the fear, both fear of regulation and the fear of getting back into what caused the crisis in the first place, made the banking sector, the traditional banking sector, more aware. So, as it usually happens in finance, whenever there is some kind of regulatory restriction, there's always a different way to sort of create new products, and so different sort of structures came in, and funds being one of them, that started lending to companies that banks did not want to lend to anymore. It's simple as that.
Some people out there think that the scariest word out there is shadow banking. And from what I understand, what you're saying is this is actually spurring what people often categorize as part of being in the shadow banking part of the world.
Well, the EU tried to regulate shadow banking, but it's a scary word, and it's obviously something that governments have fear of, because banks have very strict regulations. For instance, think about capital regulation, right? How do you, in your balance sheet, how much capital do you hold against certain types of transactions and certain types of lending that you do? And so, when you factor in for that, you understand, you realize that when you're actually restricting this, and banks are like, okay, we really don't want to touch this anymore because it's too risky for us, then someone else will step in, because there are still companies that are perfectly viable, that produce profit, that still need working capital in some ways. And so they're going to ask someone, and someone will have to provide that capital. It's not that all of a sudden you don't have that need anymore. And if there's a need, and someone else different structure will step in.
So the government can't prevent growth, regardless of how much you try.
I never said that. And actually, I worked in financial regulation for a while in Europe.
Yeah.
I was at the European Commission at the time when the Alternative Investment Fund Managers Directive was drafted back in 2010. And for as much as you can regulate the market, the market itself, the market force itself, will find different ways, especially if there's a need. Again, let me reiterate: if there's companies wanting capital and banks cannot lend it to them, someone else will. Especially if these companies are profitable, and so if the risk of that lending is And in finance, there's always an opportunity when you can assess risk better than others. If I think that lending money to Lotta is not as risky as most people think, then I'm going to end up lending money to Lotta, and I'm going to do it at better conditions because no one else will.
So people excited about the space who are listening to this, not professionally, but want to get the exposure. How can regular people get exposure to the space now? Have there been like created indices, ETFs that people can kind of pile into so that you don't have to sign all the papers to be an LP and pay all the fees and all of that kind of things?
Listen, I want to hone in on this because I did work for a company that did exactly this. In my past financial experience, they took positions in private credit funds, and then they sort of sold these positions to pooled retail investor capital, which is a great thing. The problem being, as I'm sure you figured out by now, financial regulation once again, which is a little bit asymmetric, right? It allows retail investors to compete for profit on retail trading platforms where they go against Citadel to make money on public markets, and they typically retail investors, if they want to trade on a daily basis, they tend to lose money because they don't have the resources to and the access to information and so on and so forth. So that is allowed, but then they cannot put a certain amount of money into a private credit fund and a private credit that puts money into private credit transactions because the minimums are very high, because there are regulations on what kind of qualified investor can put money there. I think, I'm not 100% sure, but I think it's only QPs for the most part that can.
So explain that QP.
Qualified purchaser, which is a higher level than even accredited investor. So you have to really have, and this is for retail, right? So if we're talking institutional investors, it doesn't matter. Like you will end up getting exposure to private markets anyways through a pension fund that invests in a venture debt fund, right? So you're gonna get it anyway. But if you want direct exposure, you can't have it because the minimums are very high, except if you use one of those platforms. They're usually fintech that came out recently. I don't want to give names here, but you'll probably read in the piece that that some of these platforms also collaborated to this piece. But I mean, aside from that, and not wanting to do a publicity stunt for private credit allocations, there is this issue that a private credit transaction is usually structured by an investment professional, right? So and default rates are historically being very low and so on. There's a number of reasons why the level of trust from an investor in this should be even higher than it is when you're buying certain public stocks at overinflated prices. And again, I don't want to make names. I don't want to put names down again. Otherwise, the CFA Institute will probably cut it anyway.
Probably. Be careful. But maybe you can explain a little bit more when it comes to these retail options. Not something you're obviously not advocating, but what are you actually buying? Are people actually indirectly getting stakes into credit into companies, or is it something else that is happening?
You're getting stakes into private, and usually into private credit funds, or it could be also into private credit transactions, let's call it alternative credit for the sake of it. So you're basically getting a piece of a private credit transaction, of an alternative credit transaction. Could be real estate debt financing, could be trade finance. It could be either a single transaction or an entire fund, which in turn gives you exposure to a number of transactions. This, again, happens on platforms because these platforms have been able to work, and again, I don't want to use this word because it sounds bad, but work around the regulatory requirements by taking this position first and then sort of passing it down to retail investors. And so the investment from a retail investor wouldn't really be directly into the fund. it would be in that specific position that has been uh, opened or acquired or allocated by the intermediary, which is the platforms that we were discussing. It's complicated, but bottom line is you can get exposure directly or indirectly. You probably already have exposure to alternative credit through your 401k.
Yeah.
Or if you have, you know, again, like a private wealth advisor, he probably put some of your money into private markets. And, some of that money may already be, have been passed through institutional vehicles to alternative credit transactions. I hope that makes sense. It's not too
Yeah.
complicated.
No, exactly. No, that's a good reminder. Like you might not be missing out. Check with your pension fund, see what you already have. But no, that's interesting. So when we think about where private credit fits into the bigger space of, if you were a long-term investor, you might do a 60-40 public bonds and public equity portfolio. And now this piece comes in and you ask, why would I do this? So clearly it's what most people would think, which I think is right, is higher risk and higher returns. You want a higher returns, but it comes with higher risk.
Don't
Now,
we? Sorry, sorry. Go ahead, Lola.
I got
It's,
those
it's kind of
initials.
fun.
Go ahead.
Go on, go on.
And part of the risk we're thinking about is often one of the risk part of the risk premium, right? Is the illiquidity risk premium, and this is fascinating part when it comes to private markets. I think both on the equity and debt side. Often we think of this as a positive premium, right? It's a bad to have illiquidity. You want to be able to pull your money out when you need it for your personal reasons, as well. If the markets drop, you want to be able to buy and be greedy, so to speak. How do we understand that some people actually are talking about the liquidity premium actually being a good thing? You hear about this. It's a good thing that you're locking in money. Does that make sense to you, or what's your view on that?
No, first of all, I want to address the percentage thing. I mean, right? I think you've read endless articles from the Wall Street Journal talking about the 60-40 portfolio. And I think generally speaking, in financial markets, especially in the past years of financial compression, there's been the feeling, the sense that bonds and stocks are so correlated that you either the whole portfolio makes money, but you're not really actually hedging in some ways, because you either gold goes up or gold goes down, right? If rates come down, stock market goes up, and your bond allocations grow in value. So some people say, okay, add more alternative credit or private market allocations in general, which have lower correlation with the rest of your portfolio. So that's a theme. I don't want to get there. Some people say, you get very wealthy individuals, they put 20% to work in private markets. Is that something for everyone? I don't know, and we're not going to give financial advice here. But what I will say is that we tend to think that we can time markets, but we can't. So where illiquidity is actually something positive is that it forces us to have a longer time horizon, where we have to just wait rather than liquidate our position just because we get panicked or we get scared. I tend to do this personally also with my public market allocations. I don't take money away unless my investment thesis changes. But if you think about alternative credit, you're thinking about a transaction that's been structured. It has a certain timeline, and the money goes in, and there's you have to look at the potential for default, and that usually is very clear. And so when push comes to shove, and you're rewarded for that, that there's a beginning, that there's an end, and that in that amount of time, even if you feel very scared about your allocation, you can take it out. And that often is a good thing, not a bad thing, because we tend to liquidate sometimes at low prices just because we tend to get scared. There's an entire literature of psychology related to behavioral finance that basically tells us that we suck at timing markets, and that's just a fact, and it's been medically proven. So I remember there's an experiment. I don't know if it was Richard Thaler that did this, but he put a bunch of MBA students into a room and then gave them a stock to trade. And he said the actual value of the stock is $20. And after 20 minutes, the stock was trading at 35 and people were buying. So after being told the actual value of the stock, people were so we are psychologically not wired to do that kind of work. So sometimes it's better to put the money there, forget about it, and look at it, 20 years from now. That said, some people are trying to boost secondary markets for these investments, and I'm not entirely sure that this isn't being done as we're talking. I guess we'll see how the space evolves.
And boosting secondary markets would mean finding faster, easier, cheaper ways to actually be able to sell and to buy
Yes.
already taken on positions, so to speak.
Either the problem with these investments is often it's valuation, right? So how do what's the valuation at a certain time? It's can be very murky during the duration of the investment. Sometimes, as you will read in the piece, the realization comes at a certain time, right? In the life of the investment, and so until that time you don't really know what the value is. So but this all comes from the way that we tend to think about financial investments in the first place, because we're used to public markets. Our brain is sort of connected to that way of trading, and this simply is a different way of investing, and it has its merits.
And most of the people that listen to this probably, the majority of listeners will believe that they're better than average traders and say, I'm not such a fool. I will want to buy when the price is low and sell when it's high. But you're saying even the professionals tend to have a hard time with that.
Listen, you're competing with. I mean, the professionals have a hard time doing this in the first place. I mean, some people. Again, I don't want to name names, but there's been a famous fund that is technology oriented that has lost a lot of money recently, and these are the stars, right? These are the people that have entire research teams, and you're sitting there with your laptop and you're thinking that you're gonna be able to time the market. Come on,
So with that, I really hope that we're spurring some of the interest here of our listeners and our viewers to check out the piece. So as an overview, you and Philip Clemens helped us put this together. You edited it, and you got a great list of contributing authors. So thank you so much for your help with this. Would you like the people reading this, what do you think they should expect? Why should they read it? What do you want them to take away from reading the piece?
So I want to do a shout out to Phil. He's a good friend of mine. He's a brilliant guy. It was his idea, so I really literally tagged along. He had this in mind in the first place. He's a brilliant guy, and if this is a successful brief and if it helps people, it's mostly because of him. Our goal is really to shed light on an asset class that tends to receive a more limited coverage. I think I said it multiple times during this interview with you, Lotta, is most coverage is on public markets. Most people think about public markets. Most people are crowding public markets, and sometimes and even the again, nothing bad to say about the CFA Institute, but even if you look at the curriculum and so on, that there's a lot of attention on public markets. It's normal, it's where most of the money is right now. But shedding the light on something that people think maybe more esoteric really helps, because it gives investors some perspective. It sheds lights on what I believe is a regulatory asymmetry. So the retail investor conundrum that we discussed before, right? Why can't you not access these investments? Why are people who have a lot of money, do they have a lot of allocations to these and make money? And why can't you with 25 grand or 20 grand or 15 grand rather than having to put 250 or half a million in? So the reason was to shed light on this particularly fascinating small space, and also it grew 13-fold in 18 years. So
Wow.
I think it sort of deserved more attention than it got. So I hope
Yeah,
that
I
covers.
certainly. Yeah, thank you so much. Yeah, and I certainly hope this conversation has highlighted to people this is a really exciting field. It's up, it's growing, increasingly large. There are opportunities to gain exposure, but do your homework, start learning about it, and this piece should be a good start for people to learn about it. So, thank you so much. And just as we finish off here, it'd be great to hear a little bit what you do. Tell us about Noosk. What do you do there, and what would you like people to connect you over and things like that?
Yeah, so don't expect anything on the private credit space. We started with two partners. We started working on um, Noosk, which is a platform for knowledgeable people to have a place to share their insights, drawing from the experience of communities that have popped up on various other social media platforms. Our research showed an evolving world where a lot of thematic content creators have mushroomed in areas such as finance, political science, law, or even marketing. And we thought these people deserved a place to feel comfortable sharing in a community setting. And so, we decided to build it, and we're testing it, and we're getting feedback, and we use a lean startup model. So we're going to continue to iterate until we find product market fit. If you
Excellent. So
want to check it out, it's noosk.co, and it's available both on web, and there's a mobile app as well.
that's Noosk
Right.
dot co.
Yeah. It comes from Greek, from words knowledge in Greek. So,
Great. Well, thank you so much, Alfonso, for joining us. And thank you, everyone, for tuning in. This has been the Financial Thought Exchange podcast. I'm your host, Lotta Moberg. And our guest today was Alfonso Ricciardelli. And thank you so much for tuning in. And we'll see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.